Here is the uncomfortable question facing every bookkeeper in 2026. If software can capture bills, suggest categories, match payments, and reconcile high-confidence transactions, what exactly is the bookkeeper's job? The honest answer is this: the bookkeeper is not dead, but the job description is being rewritten. This OBG Outsourcing guide explains how bookkeepers can move from processing every transaction to designing, monitoring, and improving AI-assisted financial workflows. From data entry to financial integrity architect, manual data entry was once a major part of bookkeeping. Today, accounting platforms increasingly use AI and automation to capture invoices, recognize vendors, categorize recurring transactions, match bank activity, and identify possible anomalies. If software can process the routine volume, paying skilled people to retype every transaction no longer makes sense. But that does not mean every transaction is correct, or that every business is ready for fully automated processing. A recurring software subscription is high confidence, routine work. A $25,000 shareholder wire is not. It could be a loan, a contribution, a distribution, or a transfer. When the evidence is insufficient, the system must pause and route it to a human. Automation performs best when transactions are repetitive, well-documented, and governed by reliable rules. Accounting becomes harder when the facts are incomplete, unusual, or open to professional judgment. Routine work is automating. Dispensability is not. The modern bookkeeper is becoming a system pilot. Instead of manually touching every transaction, the bookkeeper designs the workflow, monitors its health, and intervenes when automation cannot reach a supportable conclusion. The old focus was entering transactions, attaching receipts, and reconciling line by line. The new focus is configuring accounting rules, validating data sources, monitoring automated activity, reviewing exceptions, and analyzing trends. Your value is no longer measured by how many transactions you type. It is measured by whether the workflow produces accurate, supportable financial information. The keyboard is no longer the bookkeeper's most important tool. The control framework is. A financial integrity architect defines how information should move through the accounting system. That means mapping the chart of accounts, defining vendor rules, setting materiality thresholds, identifying transactions that require approval, and preserving an audit trail. Consider a single transaction. Harbor Insurance, $4,850. The AI suggests general insurance, but the policy document says workers' compensation. The accountant changes the classification and adds a note. Classified according to policy documentation and prior period treatment. The AI recognized insurance. The accountant understood which insurance, why the classification mattered, and how the treatment should stay consistent. AI detects patterns. Accountants understand context. Exception management means focusing human attention where it creates the most value. Picture 3 queues. A green queue of routine, supported transactions, recurring software, regular rent, matched customer receipts. An amber queue that needs detailed review, new vendors, unusual amounts, missing documents. And a red queue that requires professional judgment, shareholder activity, loans, related party transactions, fixed assets, and tax payments. I no longer review a $20 subscription with the same intensity as a $100,000 shareholder transfer. Risk-based review allows routine transactions to move efficiently while directing people toward material, unusual, and unsupported activity. Say a batch of 800 transactions is processed. 720 are routine. 62 need detailed review. 18 are high-risk exceptions. This does not mean the other transactions are ignored. They remain subject to rules, analytics, reconciliations, sampling, and financial statement review. Confidence determines review depth. It does not eliminate accountability. A high automation rate does not prove that the books are complete. The system may report that 98% of transactions are categorized, while the bank reconciliation still shows a difference of $12,640. Categorized is not reconciled. Transactions may still be duplicated, missing, posted to the wrong period, or assigned to the wrong account. So the bookkeeper checks the controls. A duplicate payment of $8,000, a missing transfer of $4,500, a bank fee of $140, and the difference falls from $12,640 to zero. AI can identify possible causes. The bookkeeper verifies the evidence, resolves the difference, and documents the correction. Automation can break the direct relationship between every transaction and a minute of human data entry time. That creates capacity, but only when the workflow is standardized, monitored, and reviewed. A firm may be able to serve more clients without increasing repetitive processing at the same rate. However, actual capacity depends on client complexity, document quality, software, internal controls, and the number of exceptions. Automation creates potential capacity. Standardization makes it scalable, and the efficiency gained can be reinvested into better reviews, faster month-end closes, stronger client communication, cash flow forecasting, and advisory services. When value comes from workflow design, control, and insight, time spent typing becomes a weak measure of service quality. Clients do not actually want 10 hours of bookkeeping. They want reliable numbers and fewer surprises. Books closed on time. Exceptions resolved. Risks identified. Cash flow explained. Value-based or fixed scope pricing may better reflect the outcome, but only when responsibilities, deliverables, and service boundaries are clearly documented. When books are updated and reconciled faster, accountants can move from historical reporting to forward-looking conversations. Why is cash declining despite higher revenue? Which customers are paying late? Which expense increased unexpectedly? Here is what that sounds like. Your revenue increased by 18%, but cash declined because receivables grew and customers are paying 12 days slower. That is far more useful than a profit and loss statement with no explanation. The advisory opportunity does not come from AI alone. It comes from combining current data with business context, communication, and professional judgment. To remain valuable in an AI-assisted accounting environment, bookkeepers should strengthen 5 capabilities. What? Accounting fundamentals. You cannot review automation if you do not understand debits, credits, cutoff, accruals, and financial statements. Workflow and software design. Learn how bank feeds, rules, integrations, and automated entries interact. 3. Exception analysis. Understand why a transaction is unusual and what evidence is needed. 4. Data and security governance. Use approved tools and protect confidential client information. And 5. Communication and advisory. Translate numbers into decisions the client can understand. Accounting knowledge plus technology plus judgment plus communication. OBG Outsourcing helps accounting and CPA firms modernize their back-office workflows through white-label bookkeeping, reconciliations, cleanup, financial reporting, and human-reviewed automation support. That includes AI-assisted bookkeeping review, human exception management, QuickBooks and Xero support, bank and credit card reconciliation, month-end close, historical cleanup, and tax-ready financial reporting. The objective is not automation without accountants. It is automation that allows accounting professionals to focus on quality, judgment, and client value. AI-assisted, human-reviewed, firm-controlled. AI did not remove the bookkeeper's role. It raised the standard for it. The future does not belong to the bookkeeper who competes with AI at data entry. It belongs to the professional who knows how to design, control, and improve the financial system around it. Ready to modernize your accounting workflow? Contact OBG Outsourcing and subscribe for more practical guidance. This video provides general educational information. AI capabilities, accuracy, and efficiency vary by software, configuration, business complexity, and data quality. Automated outputs require appropriate human review and professional judgment.